range indicated by our comps. Not the highest, again. General Mills is trading at 1.9 times. We've assumed 1.6 to 1.7. The way we've done that, just like we talked about up here, I took a look at our companies, our hypothetical companies' profit margins. Based on those profit margins, I selected multiples of companies that that have similar levels of profitability. All right. So what I did, I apologize for the toggling back and forth. It is kind of necessary. If we look at our EBITDA, latest 12 months EBITDA is $33.2 million. It's a profit margin, an EBITDA margin of 17%, which if we look at our comps, we go down to our EBITDA margins, 17% tends to be toward the higher end of the range. It's not the highest, but it's toward the higher end of the range. On a next year basis, our EBITDA margin is 18%, also toward the top of the range, but not the highest. Okay, so I did an analysis of profitability, and I'm taking, at the end of the day, and it does become somewhat of a subjective analysis here. You're not typically going to be able to pinpoint or run a regression. It's going to give you an exact number. But I've subjectively selected ranges of multiples that tend to be toward the higher end of our comps range. If we apply those, it gives us a valuation range of 312 to 331.5 on an LTM basis, 308 to 328 on a next year basis, based off of next year's revenues. All right, so that's the total enterprise value to revenue multiple. On the EBITDA multiples, all right, this is a little more difficult in this case because Company A is a made-up company. I can't really go back and analyze how well or how poorly they've managed their working capital because I made them up. I don't have historical data. I don't have necessarily historical data on how well they manage their CapEx program, and I don't know who their management team is because they don't exist. All right, so in this case, I've selected multiples, EBITDA multiples, that pretty much approximate what's indicated by our comps. In other words, our comps trade from 8 to 11.2x on a last 12 months basis, 7 to 10x on a next year basis. I've chosen multiples of 9 to 10 times LTM EBITDA and 8 to 9 times next year's EBITDA. And if I multiply those out, I'm getting ranges of value anywhere from 295.2 all the way up to 332.1. Pretty similar range to what I got using my revenue multiples. And then on the PE multiple, I've done kind of a similar exercise. I've selected multiples that approximate the range indicated by our comps, 13 to 17 times on an LTM basis, 12 to 16 times on a next year basis. The only difference between the price earnings and the total enterprise value, the TEV multiples, again, these are equity multiples. So if I multiply an equity multiple by earnings, it's going to give me market value of equity, not total enterprise value. Right? So that's why we multiply these together, we get market value of equity, we add our debt, we subtract our cash using that total enterprise value formula we went over last week to get to enterprise value. Okay, so you can use a PE multiple to get to enterprise value. You must take these interim steps though. Does that make sense to everyone? And if we multiply these out, we add debt, we subtract cash, we get ranges anywhere from 261 to 335. Again, pretty similar to what we've seen based on our other multiples. And again, these are on a minority interest basis. So if we're valuing this company for, say, an IPO, we're going to be selling some minority interest in the company as part of our engagement with the company, then this is probably a really good way to go, looking at comparable companies. If we're looking at the company, we're trying to sell the whole company, we would probably want to take these and add some control premium to it to reflect the fact that we'd be selling 100%, we'd be selling a controlling interest. And we'll talk more about that in a minute. All right, well, we also spread a couple precedent transactions. We finished our precedent transactions approach, so now we've got multiples that we can apply in this regard. If we go back to our homework, if we go to the precedent transactions tab, we scroll down here, we can see that our mean and median, or our median and mean, Enterprise value to revenue multiples, 2.7, 2.72 times. EBITDA multiples, 14.3, 14.5. Pretty much approximate what we've chosen in here. And many of the same rules apply. If we're looking at precedent transactions and we're looking at a total enterprise value to revenue approach, ideally what we want to find are target companies that when they were sold had similar levels of profitability to our company. So if we remember back to that, EBITDA margin was 17%. If we look at our precedent transactions, we'll see EBITDA margin 17%, sort of in the middle of what's indicated by our comps, maybe just a little lower. And so we've selected 2 to 2.5 times revenues as our multiple, where the median and the mean were a little bit higher than that. Okay, so we've taken into account profitability here. On the EBITDA side, again, company is a made-up company. It's a little hard to analyze how well they manage their working capital, et cetera. So 12 to 14 times multiple, a little bit lower than the median, the mean, but still approximating what was paid in comparable transactions. So once we have those multiples, again, the exercise is simple. We multiply them out, giving us a range of 390 to about 488 million. You'll notice this is a good bit higher than the ranges that we saw in our comparable public companies approach, mainly because of that control premium. That will explain the difference in this case. And if we look at our precedent transactions, we see that median control premium was about 16%, the mean was about 15.5%. So that explains that variation in value between our two approaches. And again, if we're pitching to this company A, we're trying to win their business as their M&A banker, we're going to sell them on a controlling interest basis. This precedent transactions approach is probably going to be the best way for us to figure out what valuation should be, because it's already on a controlling basis. If we wanted to, again, if we wanted to convert our comparable public companies approach to a controlling basis, we could multiply these by 1 plus the control premiums that were indicated in our precedent transactions. We're not done with valuation, all right? You'll see that we still have to populate our numbers for our DCF. That's going to come once you're done with your homework. So when you finish your homework, there'll be a low, there'll be a high in your DCF model. And those will get populated right here. Once we have a full data set, then we can start drawing some conclusions. Right? But we're 2/3 of the way there. We've done precedent transactions, we've done comps. All right, so we talked about some of the characteristics that go into selecting multiples. Maybe I put the cart a little before the horse. Typically what we're going to do before we select our multiples is we're going to analyze our data set. That is, if we've got 10 different multiples and they range from, let's say, 1 to 5, 1 times revenues to 5 times revenues, we're going to want to take a look at how that data set is structured. Maybe there's one that's on the very low side. Maybe most of them are clustered between 2 and 2.5. You've got a really low outlier and you've got a really high outlier. In those cases, you would want to understand why those exist. But in many cases, you might eliminate them. You might drop an outlier on the low side, you might drop an outlier on the high side, and then calculate a median, or then calculate a mean, or look at the rest of your data set. Maybe you might calculate an upper quartile, lower quartile, you might do deciles, do some other statistical approaches. But it's really going to depend on what the data set looks like, what the raw data look like, to determine how we're going to adjust for some of those factors. So you might eliminate outliers. As we did, we took a simple average, we took a simple median of our whole data set. You could do a total average, you could do a stripped average. I sort of gave an example of a stripped average below, or a moment ago. Take the high, take out the high, take out the low, average the rest of them. So that might be a stripped average. And then again, upper and lower quartiles. Most of the data in our model were pretty, I didn't see really any outliers. There was a pretty normal data set from what I could gather. But again, if most of the companies are valued between 1 and 1.5 times revenue, and there's one that's 3 times revenue, we'd want to at least understand it and figure out whether it was an outlier and we needed to take it out of our data set. When we look at companies, we want to rate those in terms of their risk. We kind of talked about this, risk, their growth, their profitability, et cetera. Obviously, comparable public companies approach, precedent transactions approach. We want to find companies that are as comparable to our subject company as possible. And again, when we're investment bankers, we're typically speaking in terms of ranges of valuation. We're not often going in, actually you'll pretty much never see going in on the early side of an engagement and saying this is the number and that's it. We're going to speak in terms of a range until we know more information. And as I touched on last week, there's also the notion of public versus private values. We're valuing public companies as part of our comparable public companies approach. The stocks of those companies are pretty liquid. Anyone who owns shares of stock in Kraft or ConAgra or General Mills, if they wanted to sell that, it's a pretty straightforward and quick exercise. They call their broker, they go onto E-Trade and sell the shares, and they can get pretty much instant liquidity. Well, if we're valuing a private company, if company A is private and we own shares in that company, that's going to be a very different process when we go to unload those shares. It's probably going to be time consuming, it's going to be costly. We're going to have to hire someone generally to sell those shares. And the buyer, because of that lack of liquidity, is probably going to demand some type of a discount. Right? So if you're valuing a public versus a private company, you need to be mindful that private companies typically have a lack of marketability associated with them. There are a lot of academic studies that talk about what those discounts can be, generally 25 to 45%. But I've seen them all over the map. I've seen them as high as 70%. I've seen them as low as 5%. It really depends on the situation. But generally speaking, I think 25 to 45% is a typical range of liquidity discounts you'll see. You can also sometimes, and I valued a public company once where we had to do a liquidity discount because they were so thinly traded. And because a lot of their shares, big blocks of their shares were controlled by just a few people. So if somebody came in and got a small position, it might still take them a while to sell those shares even though they're public companies. There might be very minimal research coverage, there might be a thin float, or not much of a float, they don't trade very often, that type of thing. And again, these come with a little bit of experience and just seeing situations and getting used to taking them into account, but be mindful, especially valuing public versus private companies. All right, so again, let's talk about the third of our three valuation methodologies. Again, discounted cash flow analysis. The first two valuation methodologies were what we call relative valuation methodologies, in that they're based on the application of multiples. DCF, on the other hand, is what we would call an intrinsic valuation methodology. We're really looking at the company on a standalone basis for the most part. And a lot of folks might refer to it as the income approach. You'll hear that a lot of times, especially real estate appraisers will refer to this as the income approach, but it's basically a discounted cash flow analysis. Right, who's done a DCF? Okay, I would imagine a good number of people. Anybody who's taken a finance class has probably been at least exposed to DCF. All right, but in the real world, as we talked about before, as long as we have enough data to do a precedent transactions approach, comparable companies approach, those tend to be a little more heavily relied upon than DCF. They're a lot more, I think they provide a more real-world example, and as we'll see a little bit later, DCF can have a lot of sensitivity to the types of inputs that we might put into the model. And some of the inputs that go into the model are questionable in terms of their validity. We'll also talk about that a little bit later. All right, but basically a DCF, what it does, we're forecasting the free cash flows of a company into the future. We're discounting those back to the present and expressing them in present value terms. What is the value today of cash flows we expect to receive in the future? And in that process, in that discounting process, we're taking into account what would an investor's required rate of return need to be to invest capital into that business. Right? When we get to the weighted average cost of capital, we'll talk a lot about that. But that's basically what a DCF is. And if you break it down into 4 concrete steps, we've got what we've listed up here. Obviously, if we're going to discount forecasted free cash flows back to the present, we need to first have forecasts. So that's the first step in our model is, number one, identifying components of free cash flow. We're going to show you what those are in a minute. All right, we're going to build, oftentimes we're going to build our own projections. Sometimes the management of the company will give us projections, in which case it saves us a little bit of time. We might build our own projections using some assumptions. That's an exercise we'll do tomorrow. So if you're in a situation where the company doesn't provide them, you'll know how to build them yourselves. And we'll build these again using assumptions, and typically we want to keep in mind historical figures when we do that. That is, if a company has grown 3, 4, 5% a year over the last 20 years, it's probably going to be hard to justify using a 20% growth rate, all right, absent evidence that would support that. Also need to decide how many years we want to forecast. Typically in banking, private equity, we'll do probably like a 5-year DCF. That is, we'll forecast the company's results for the next 5 years, and then we'll make an estimate of what its value will be at the end of that period. We're going to talk about that in a minute. Okay, sometimes in commercial real estate, you'll see a 10-year DCF. It's a little easier to forecast in commercial real estate because a lot of times you have leases, you've got contractual obligations telling you what your revenues are going to be. All right, but that's the first step, forecasting our cash flows. The next step, as I mentioned earlier, we have to discount those back to the present. So we need a discount rate. In our model, it's going to be known as a weighted average cost of capital, often referred to as a WACC. We're going to go through a whole analysis on how we calculate a weighted average cost of capital later today. All right, but it's basically a blend of required rates of return of the debt investors and the equity investors of the company. We blend that based on their contributions in the capital structure. And the cost of equity is typically estimated using something called the capital asset pricing model, CAPM. We're going to go through that as well. All right, so we forecast our cash flows. We need to know what our discount rate is. Third step is we need to figure out what is something that we call the terminal value. Exactly. We're assuming, we're doing a 5-year forecast, but we're not assuming the company goes away after 5 years. Unless we're evaluating some finite 5-year project that we do expect to end after 5 years, the company is going to have value from year 6 into infinity. And that terminal value will estimate that value at the end of our 5-year forecast model. So in other words, at the end of 5 years, we're going to say, what is the present value at the end of year 5 for the cash flows from year 6 into infinity? That's our terminal multiple approach. Couple different ways to calculate that, either using an EBITDA multiple on year 5 EBITDA, or maybe doing something called a Gordon growth approach. We'll talk about both of those a little bit later. But at any rate, we're figuring out the value from year 6 to infinity, and then we discount that back to present value as well. So at the end of the day, we're going to forecast cash flows for 5 years, discount those back to the present. We're going to forecast the terminal value, year 6 to infinity. That'll be expressed at time 5. We'll also discount that back to time 0. And at that point, it's really just a matter of adding them up. What's the present value of our cash flows from year 1 to 5? What's the present value of our terminal value? We add those together. That is the present value, the total enterprise value of the company at time 0.